Can you refinance a hard money loan into a mortgage? What if you could turn your short-term hard money loan into a long-term mortgage? You can, but it's not always simple. Refinancing a hard money loan might save your deal, or you might be able to turn it into a long-term rental. I'll explain when it makes sense. In this video, I'm going to walk you through how to transition from a short-term loan to a long-term mortgage and the traps to avoid along the way. In this video, you're going to learn how to safely refinance a hard money loan, what lenders to look for, and when it makes sense to pivot from a flip to a rental. So the answer is yes, you can, but the real question is, do you need to, or do you just want to? A lot of times, if you're in a house that you're planning to flip, and for some reason things go over budget or things don't go as well as you'd like them to, you still have equity in the property, but not as much as you wanted to, or maybe you're actually over budget and you need time and appreciation on your side to be able to actually make a profit on that property. Let me give you an example. A few years back, I had a property that I was trying to renovate, and for one reason or the other, we had a lot of problems and permit problems, and it took over 2 years to get the initial permit to get started. Not what we planned, but sometimes when you're flipping 100 houses a year, some things can fall through the cracks. Some of that mismanagement on my company happened also. So as it sat for 2 years, the interest from my lender started to compile and compound and get greater and greater. And as the debt got higher, I realized that flipping the house for a profit wasn't going to make sense. I'd have to bring money to the table to actually sell and pay off my hard money lender. So I chose a different path. I decided to finish that home into a very high-end, short-term Airbnb type rental. Then I did a cash out refinance with just enough to pay off my lender. No profit, but I paid off my lender. Now I owed the bank money at a much lower rate, around 4.5%. And I turned that into an Airbnb that generated some cash flow every month from the rentals. That was all fine and dandy. But the great part was, about 5 years later, I was able to sell that house for a $100,000 profit because I took longer to sell the house. I call that a long flip or a slow flip. But the truth is, because I refinanced the hard money or the private money loan and put it in a long-term debt, it gave me the chance to take advantage of appreciation, and I got some great tax benefits along the way. So sometimes it makes sense. So if you decide you want to go with the same kind of play, well, let me tell you exactly who you have to borrow that money from. Typically, you want to go to what's called a local portfolio lender. A portfolio lender is typically a smaller bank or credit union that's usually regionally based in your area, maybe state-based, but usually regionally based in your area. And they are not in the business of selling their loans out to other investors. Matter of fact, they keep the loans what's called in-house in their own portfolio. That's why they're called a portfolio lender. And the great part is they can be a lot more flexible with terms. They are more of a relationship banker. They want to loan money and keep it in their local community. So find a portfolio lender to work with. Now, you don't just go in and say, I want a mortgage for my property. If you've done this right, or you spent any time in my channel, which please do, you can learn that you should be running your business through an LLC. You should have a separate entity. Now, the LLC is who will take the loan out. It's going to be a commercial loan through their commercial lending department. Don't let those terms scare you. A commercial lending department is just someone that deals with apartment complexes and houses and rental properties. That's what they loan money on. They don't loan money to just consumers. They loan money to entities. Now, the great news is for you, any loans you take from the commercial department almost always will not reflect on your personal credit report. Did you know that? That's another reason why it's so important to have your business in an LLC or a separate entity. Now, they're going to use your credit score to determine the rate and the terms that you get for your mortgage. Remember, even though it's in the name of the business, you're still going to have to co-sign for that as a member of the LLC. That's very normal and very typical, but it won't show up on your credit report in most cases. Be sure to ask that of your lenders before you even start doing business with them. Your debt to income ratio is also going to matter. They're going to look and say, okay, well, how much do you make and how much do you spend? You want to have about a 1.2% debt to income ratio. So if your debt is $10,000 a month, they want to make sure that you make at least $12,000 a month. And the property also needs to have a debt to income ratio of about the same value. Some lenders have a seasoning requirement, which means they will not do a cash out refinance with you until you've owned that property in this current entity for at least 3 months, 6 months. I've seen one for 30 days one time. I've seen one for a year. I would highly advise you to find a bank or a portfolio lender that does not require seasoning so you can turn these properties over fast and not sit on them for a year with hard money rates. If you're unable to find a local portfolio lender, you can move nationally and look for a DSCR, debt service coverage ratio, which means there are lenders that will loan money specifically on the property and how the property generates money. As long as the property has at least a 1.2% debt to service coverage ratio, meaning that if it costs you $1,000 a month for all the expenses in that property with everything figured in, and you can bring in $1,200 a month in that property is financeable by itself. They're going to run your credit to make sure that you are a decent human being and paying your bills and you're not in an active bankruptcy, but they are very lenient. Now, you're going to pay about a point more for interest, but a whole lot more flexibility. These loans are getting more and more common as time goes on. So if you are unable to get a local loan, jump right into a DSCR lender, build that relationship because that will set you free. Always use the BRRRR method. I call it the buyer method, but the BRRRR method is you buy a house, then you renovate the house, then you rent the house, then you refinance, then you repeat. I like the buyer method, which is buy with instant equity, then renovate, rent, refinance, and repeat. That way you have money in the bank when you start. But that's the method that you want to use and continue using as you build your wealth and you build out your lending base with the DSCR loans or local portfolio lenders. By the way, that is the crazy wealth builder in real estate investing that most people don't talk about. It looks sexy to make a lot of money from flipping houses and make 50 grand or 40 grand or 100 grand for flipping a house. But what they don't tell you is when you have a piece of property sitting there that someone else manages for you and in 5 years it makes $100,000 and the debt's getting reduced and reduced and reduced by your tenant and you're not paying for it, man, that's a powerful tool. When you're thinking about refinance timelines are usually around 2 to 3 months for them to all do their due diligence, get all their paperwork together, and run everything that they have to run. It doesn't happen overnight, but it does happen. If you know you're going to refinance, by all means, get a tenant in there right away to stop any hemorrhaging or bleeding of cash, and that way the bank will see that you're taking aggressive action too, and they'll be impressed with that. So here's how to avoid some refi fails that will cost you time and money. Look like a professional when you show up. Have your documents in place. Have your LLC documents in place. Have your ownership documents in place. Make sure that you have your personal financial statement in place, and be ready to show them exactly who you are, what your plan is, and what your exit strategy is for that property. These relationships are crucial to the long-term success of your real estate investing career, so treat them as such. You can refinance a hard money loan, but only if the numbers make sense. And that only makes sense if you buy the house correctly out of the gates. I put together a training right here after doing 1,200 deals. It'll show you how to define the perfect buy box for you. Notice my buy box? So you know exactly what houses to buy to make the most amount of profit in the least amount of time. Go check out this training right here. The link is right here in my description.